Why every wealthy person invests in foreign exchange? While most advisors recommend leaving the foreign currency exchange market to the pros, individual investors are increasingly entering the market as accessibility through the online trading platforms has improved. They're drawn into it for the precise reason that most stay away. The forex market is the largest and most liquid market in the world, and most fortunes can swing on a fraction of a penny. Simply put it, it's exciting, but very risky. Those who want to jump in, do so with an understanding of the risks and the unique characteristics of the market, says Mark Chandler, Managing Partner and Chief Investing Strategist of Bockenburn Global Forex, a trading firm specializing in currency. Some people are so rich, they get into it for the entertainment, but it can be an expensive form of entertainment, he says. Profit in fluctuations. Currency investors aim to lock in a profit through fluctuating exchange rates, which are the prices you pay for one currency in exchange for the other. Because the value of a currency is relative to another, trading occurs in currency pairs, such as the euro versus the US dollar, or the British pound versus the Japanese yen. Investors who believe that the euro will strengthen against the dollar might buy euros with dollars. If the euro appreciates these investors, they can convert the euros back to dollars to lock in the profit. While there are more than 100 global currencies, the US dollar is the benchmark and accounts for about 90% of more than 5 trillion US dollars in forex trading volume. Currency market is more volatile than the bond market, but less volatile than individual stocks. But big profits or losses are turned on tiny fluctuations in exchange rates, often by a penny or less. Because of this, investments must be large to be able to make any significant profit, so investments are generally higher, leveraged by as much as 100 to 1 or more. For every 1,000 US dollar put up by an individual, a broker will put 100,000 US dollars to work in the market. This works great if the trade works in investors' favor, but the risk of losing far more than in the initial out-of-pocket investment is significant. Another challenge for individual investors is that unlike the security market, currency markets churn around the clock. There's no opening bell or end of day close, at which point traders can take a deep breath and get some sleep, Chandler says. Doctor comes home and wants to play around the stock market? Okay, but in foreign exchange, while she's in the middle of surgery, she isn't watching the market. That may not work as well, he says. While with stocks and bonds, you can decide to invest in a sector or region that you feel confident keeping tabs on. Currency markets are driven by numerous factors and events around the world. But what the European Central Bank or the Bank of Japan is doing, for instance, he says, you have to be aware of other countries, politics, and their fiasco policies, of so many more things. Chandler says he keeps discovering new ways to lose money in the forex market. There are only 3 ways to make more money. The first is a straightforward momentum story in which you buy to benefit from an upward trend. The second is a mean reversion strategy in which a trader identifies as a currency's trading range and bets that it will return to that range after deviating. The third way is through an interest rate arbitrage through a so-called carry trade. Even if exchange rates between two currencies remain stable, traders can make money on the difference in countries' interest rates by pairing the currency with a low interest rate, such as the Japanese yen, which has a rate of -10%, with a high interest rate currency, such as the Australian dollar, which is currently 1.5%. Thanks for joining me here today. We hope I'll give you a better understanding.